Hi, my name is Phil Fiegler. I'm an enrolled agent in Oakland, California. My company's called PhilTax. You can learn more about us at www.philtax.com. This is the third in a series of 4 little informative videos about employee stock options. This one's called Stock Options and Taxes 1C, Employee Stock Purchase Plans, ESPP. Obviously, we're going to talk about employee stock purchase plans. That's when the company lets you withdraw from your pay to buy stock. One important thing you need to know right off the bat is because these have been reported so badly over the years, IRS has developed what they call an information return, which is just like a W-2 or a 1099. It's a form that gives them information about you that the company must give you when you buy shares in an employee stock purchase plan. That form's called a 3922. You need to give it to your tax professional. Hopefully they'll know what to do with it. Employee stock purchase plans on the surface seem really simple. You just volunteer to join up. They hold some money out of your pay on every paycheck, and every 6 months they buy you some shares. Doesn't sound like much has to happen, right? Well, we need to look at them a little deeper. The first thing that happens is usually the shares are bought twice a year, and a lot of companies that'll be June 30th and December 31st. Although some companies may use a different date if they have a fiscal year. The next thing I'm going to do is I'm going to give you a time frame. When you see in a time frame in a stock option tax law, it usually has something to do with what's going to happen when you sell the shares. The time frame I'm going to give you is 2 years from the date of grant and 1 year from the date of exercise. You'll run into this again when we talk about ISOs. If you hold the stock for 2 years from the date of grant and 1 year from the date of exercise, you have what's called a qualifying disposition. If you sell the stock before the elapsement of that time, you have a disqualifying disposition. Here's how it works. At the beginning of each period, usually January 1st or July 1st, the fair market value of the stock is determined. This is what we call your grant date. Although it's possible your documents from your company might call it the beginning date or the enrollment date, either way, that's what the grant date is. Now, companies are allowed to discount these plans anywhere from 0 to 15%, but just about all of them use 15%. So on that date, the company will figure out what 85% of the value of the stock is. If the stock's $100, that amount will be $85, and that'll be your initial potential option cost. We call that $15 discount the bargain element. At the end of the 6-month period, the shares will be purchased. That's known as the exercise date. The date of purchase is the exercise date. At that time, the fair market value of the stock is looked at again, and the employee gets to buy the stock at the lower of 85% of that fair market value, or the 85% of the fair market value on day one we just spoke about. So let's just say the stock went up to 120 on the exercise date. On day one, it was 100, and your potential option cost was 85. On the exercise date, the stock is 120, 85% of that is 102, so you get to buy the stock at 85, the lesser of the two. If I bought the stock that day on the open market, I would pay 120 for it. At the time you sell your shares, there may be a combination of both ordinary income, wages, and a capital gain or loss. That's important to know. There may be 2 elements in your sale. The first thing you're going to need to do is determine whether or not you have a qualifying or disqualifying disposition, because they each have a different treatment. Remember, a qualifying disposition is 2 years from the date of grant and 1 year from the date of exercise. More than 2 years from the date of grant and more than 1 year from the date of exercise. Just to refresh, the date of grant was the beginning date of the period. The date of exercise was the date the shares were purchased. We're going to talk about a disqualifying disposition first. That would be when you have failed to hold for either 2 years from the date of grant and 1 year from the date of exercise. The first thing you need to do is figure out your dollar gain on the sale. This is essentially the fair market value on the exercise date, which was the date you purchased it, less the price you paid for it. That's your gain on the sale. And that is always going to be ordinary income. It's either rare or never that there will not be ordinary income on a disqualifying disposition. And remember, ordinary income equals wages. The next thing you have to do is figure out what your tax transaction is. Your tax transaction is your net proceeds from the sale less your basis. Your basis is what you paid for the shares plus the ordinary income that was added to your W-2 in the previous step. The bad thing about disqualifying dispositions is the shares could go the wrong way. You could end up with a loss on the sale, but you could still have ordinary income. If you have a qualifying disposition, which again is 2 years from the date of grant and 1 year from the date of exercise, we need to do a few steps. The first thing is to figure out whether or not you have ordinary income. Part 1 of that is what's your gain from the sale? Essentially, the net proceeds from selling the stock less the price you paid for it. Now, that's not your tax gain. That's more or less your dollar gain. But we want to figure out what that is. If that's a gain, you might have ordinary income. If that's a loss, you will not have ordinary income in a qualifying disposition. What we do with that is if it is a gain, we compare that to the bargain element on the date of exercise. That was the 15% discount on the first day of the 6-month period, which was $85 a share in our example, the discount being $15 a share. That was the bargain element. The lesser of those two, gain on sale versus bargain element on your exercise date, is your ordinary income component. Next, you're going to figure out your gain or loss for tax purposes, which is your Schedule D transaction. Your net proceeds are your sale price, obviously. Your basis for tax purposes is what you paid for the shares plus any ordinary income that we computed in the last step and went into your W-2. If what you sold the shares for less what you paid for them was a loss, you had no ordinary income, and in that case your basis for tax purposes was strictly what you paid for the shares. There are a couple very important things to know about these transactions. The first one is many companies do not bother to report or do not track your ordinary income when you've had a qualifying disposition. So essentially, that's going to be up to you and your professional advisor, namely me, to gather your records and figure out what happened so that it can be declared properly on your tax return. Because don't forget, IRS did get that little form when you bought the shares. The other thing related to that is that in some cases, by the time you sell the shares, you're no longer working for this company, in which case whether it's a qualifying or disqualifying disposition, the company's not reporting it. You no longer have a W-2 from them because you're no longer a rank and file employee, and what happened will have to be reconstructed for tax purposes. The other thing you need to know is that more often than not, brokers do not get these transactions correctly on their gain-loss reports, so you can't strictly go by that. It's possible they know what you paid for it and they know what you sold it for, but they don't know what your ordinary income component was, which could essentially change your cost basis. These are some important things to remember about ESPP shares. Please remember that even though these videos are focused and accurate, it's impossible to take into account every single situation and circumstance. So be sure to get professional advice. Thanks for watching. You can find clips to all these stock option videos on our website, www.philtax.com. Have a great day, and you have to admit, this is good for insomnia.